That is why I quietly shifted to a more defensive position in my portfolio. As the S&P 500 hit a record high, because when the most successful investors of the last century sat outside with nearly $400 billion in cash, you wouldn't ignore it. You would ask why. Let's get started. Because I already know what many of you are thinking. The S&P 500 closed at a record 7,230 on May 1, ending 6 consecutive weeks of gains and strong first quarter earnings. Goldman Sachs and JP Morgan are both there, with year-end targets approaching 8,000. And on the surface, everything looks fine. Beneath the surface, it is very different. If you are in your 50s and 60s, staring at retirement, math is more important to you than anyone else. Stick to my point, because I want you to fully understand what I see and why it is just common sense to be more cautious now. Let's start with Berkshire Hathaway, the elephant in the room. At the end of the first quarter of 2026, Berkshire held about $397 billion in cash, up from $373 billion at the end of 2025. The largest corporate cash reserve in American business history. That is what most people hide. Berkshire sold shares for the 14th consecutive quarter, buying back only $235 million in the first quarter, which sounds like a lot until you realize that this is a rounding error for a company of this size, which happens to be their first repurchase activity since the second quarter of 2024. Buffett himself stepped down as chief executive at the end of 2025, and Greg Abel now hosts the show, but the concept has not changed. As early as March, Buffett told CNBC that, in his words, cash is as important as oxygen, but it is not a good asset. He doesn't want to hold it. He holds it because he can't find anything worth buying, which should tell you something. Look at valuations, and you'll see why. The Shiller-P ratio, also known as CAPE, is now about 42, while the historical average is close to 17, climbing higher only twice in history, with internet peaks in 1999 and late 2021. The S&P 500 hovered around 31, and the Buffett Index, which divides the total market value of the United States by GDP, now reads 231%. Buffett himself warned that anything around 200% means you are playing with fire. And we've gone far beyond that, which Fortune called the April lightning warning. None of this means a crash tomorrow. This does mean that the price you pay for $1 of corporate earnings is at the historical limit. And when you pay too much, future earnings are almost always lower. It is just math. Then there is the issue of concentration, which I don't think has been discussed enough. The top 10 companies in the S&P 500 now account for about 38% of the index's market value, while contributing only about 31% to total earnings. And the 7 gorgeous companies alone account for nearly 30% of the index. When you think you are buying a diversified basket of 500 American companies, what you're really doing is making big bets on 7 names that are perfectly priced in artificial intelligence. Jeremy Grantham, co-founder of GMO, has been warning of this since early 2026. In his view, the U.S. market is still in a dangerous bubble, and he pointed out that the huge scale of AI investment itself has become a warning sign, because the market always overestimates good news. Now let's look at what is happening in the real economy, where things are getting more and more complicated. In April, CPI reported 3.8% year-on-year, the highest reading since May 2023, after jumping from 3.3% in March, and prices rose 0.6% year-on-year. A major driver of the surge was the Iranian war in late February, followed by the closure of the Strait of Hormuz on the 4th of March. Brent crude soared from around $72 a barrel on the 27th of February to a peak of nearly $120 and eventually rose to 55%. Inflation after the oil shock not only quietly disappeared, but also penetrated everything. That has put the Fed in trouble. Policymakers have now kept the federal funds rate at 3.50% to 3.75% 3 times in a row, covering January, March, and April. And as inflation accelerates again, the likelihood of interest rate cuts priced by many investors for 2026 begins to diminish. Combined with layers of tariffs, the risks are rising rapidly. Goldman Sachs raised the odds of a recession in the next 12 months to 35% from 20% earlier this year and cited tariffs directly. While JPMorgan said drug tariffs could rise to 200% by the end of 2026, at the same time, the United States has a deficit of about $1.7 trillion over the past 12 months. Our debt now exceeds the entire GDP, and the Congressional Budget Office expects the deficit to grow to $3.1 trillion by 2036. Another thing that seems to have gone unnoticed is credit spreads. Entering 2026, credit spreads reached their narrowest 5% in the past 25 years. A fancy claim that investors have little additional compensation to take on the risk of lending to weaker companies. That complacency rarely persists, and spreads have widened since the start of the Iran war, a warning sign. Bond investors are often the first to smell smoke. One more thing is worth mentioning. American household net worth hit a record high of $184 trillion at the end of 2025, and stock holdings climbed $1.6 trillion in one quarter alone, which means that American households are now more vulnerable to the stock market than they have been for a long time. If it does, the wealth effect will be reduced in both directions. When people feel rich, they spend money, and when they feel poor, they don't. I want to be fair here because it is a real bull market. The first quarter earnings season was solid, with the April employment report beating expectations, adding 115,000 jobs, the unemployment rate stabilizing at 4.3%, and Goldman Sachs predicting a 12% rebound for the rest of 2026. JPMorgan believes that S&P can reach 8,000 points. Nvidia issued strong forward-looking guidance, pushing back the AI bubble narrative. The pullback we saw in March. The S&P 500 index fell more than 10% from its peak, closed below the 200-day moving average for the first time since May last year, and has been fully repurchased. There is nothing wrong with bulls believing that the market is resilient. I think so. I won't sell everything and I won't cash it, because it is not defensive. In my view, defensive means rebalancing industries that historically performed better when the economy slowed. Consumer goods are by far the fourth best performing sector in the S&P 500, while utilities outperform the broader index in drying, dividend-paying and cash flow-generating businesses that people don't stop using when things get tough. To be honest with you, this random fool wrote earlier this month that the historical pattern of the defensive sector's outstanding slowdown has weakened in recent cycles. So, this is not a guaranteed strategy book. Adding a little more cash, cutting the most expensive positions, and resisting the urge to chase the hottest AI names at 40 or 50 times returns feel like a reasonable way to play cards. That is what it comes down to. When the Shiller PP ratio is 42, when the Buffett index is 231%, when Berkshire holds 397 billion yuan of cash and sells stocks for 14 consecutive quarters, when inflation is at its highest level since 2023, when the Federal Reserve is on hold, when oil soars 55% in the war, when credit spreads begin to widen, when 10 stocks account for nearly 40% of the index, you don't have to predict a crash to want some protection. All you have to do is respect math. The market can definitely continue to rise from here, but the risk returns at these prices are different from 2 or 3 years ago. If you are 55 or 60, your job is not to maximize returns in the next 12 months. Your job is not to blow up the retirement you best spent 30 years building. That is why I'm more defensive now. Not because I think the sky is falling, but because when so many warning lights flash on the dashboard at the same time, the smart thing to do is slow down. Keep going. Just slow down. If it helps, click the like button and tell me in the comments how you're positioning your portfolio right now. I read every book. See you next time.